You cannot become wealthy without going into debt. It is impossible. Wealth is when small efforts produce large results. Poverty is when large efforts produce small results. It is not cash, it is not material possessions. Wealth is what's in your head. If you understand the principles of wealth, which I'm going to share with you, you don't have to have any money. But if you don't understand the principles of wealth, it doesn't matter how much money you have to start with.
Welcome to this Listen and Learn program filled with useful information. This session is designed to sharply increase your awareness on the subject and give you ideas and knowledge that you can put to work right away. As with all Listen and Learn programs, you hear from the experts, people who have already been there and who have had success. Of course, we can't hope to present everything there is to know in a short session like this, but we will give you all the important highlights so that you'll have a good overview when you've completed the session. For more information, listen to the message at the end of this cassette. Okay? Let's begin. Listen, learn, and enjoy.
Hello, my name is Robert Allen, and I'm the author of the book, Creating Wealth. And I've got a question for you. Have you ever wondered why it is that money seems to flow to some people like a magnet and seems to be repelled by others? Why is it that most people struggle financially and only a small percentage ever really make it? Is it possible to create wealth? I guess you're really concerned with the question, can you become wealthy? Well, in the next few minutes, you and I are going to spend some very important time together, and I'm going to be answering these questions for you. But before we start, so that there will be no mistake, I want to make sure that you understand, and I will say it emphatically, you can become wealthy, starting from where you are right now in 10 years or less. I'll cover with you how to develop a wealthy mindset, how to understand the principles of wealth, how to launch yourself into financial self-reliance, how to pick an appropriate strategy that's just right for you, and how to set up your wealth and put it on automatic pilot. Now, there are going to be some theories to talk about, but remember, there's going to be plenty of nitty-gritty detail and specific information that you can use immediately to help you make more money, to increase your net worth dramatically, and even help you save some taxes. And along the way, we'll delve into some of the deeper philosophical questions like, what is wealth? But remember, it's the nitty-gritty that I think you're interested in, and we'll get that. We'll cover a lot of it. In fact, my goal is by the time we get to the end of this tape, you're going to know how to be wealthy, and that includes money also. And if this goal has not reached, your time and my time will have both been wasted, and I don't want that to happen. In short, we're going to have a lot of fun. And you know what's really exciting about this tape for me? You're going to learn, and I'm going to have a chance to internalize one more time the thought that is very powerful in my life. You don't have to be crooked or unethical or immoral to be wealthy. I know that's what the world teaches, but you don't have to be that way. And we're going to talk about how to achieve win-win wealth, even in a win-lose world. So where do we begin? Well, let's begin where it all begins, at birth. And did you realize, as the first chapter of my book says, that most of us are programmed to fail financially from the moment we're born? Now, I know I'm treading on thin ice here, but stick with me for a moment. What we learn from our parents and from TV and from our schools and even from our churches does really not prepare us for wealth at all. As Josh Billings said over a century ago, the trouble with people is not that they don't know, but that they know so much that just ain't so. Perhaps an illustration would help. Back when I was just beginning in this process of becoming wealthy, we had a friend that lived in the neighborhood next to us. And while we were taking the time to invest carefully in our properties, etc., this friend of ours and his wife were spending their time investing in a career. And he became a fireman. And becoming a fireman was very exciting to him. Problem was, after a little while, he realized he wasn't making enough money. You see, he was working 24 hours on and 48 hours off, 24 hours on and 48 hours off. And the income to him was not sufficient to meet his needs. And so guess what they decided to do? They thought about it, and they decided to go back to school. He always wanted to be an engineer, and so facing them was going to be a 2 or 3 or 4 year education decision. And I met them in the grocery store one day, and I'm trying to illustrate this point of being programmed in the way the world thinks about money. And I said, "What are you going to do that for?" And he said, "Well, I'm going to go back and I'm going to earn some more money. I'm making $15,000, $18,000 a year right now, and I think I'd like to go out and make some more money." "How much more money would you make?" "Well, maybe 25, 30,000. We don't know. Surely going to increase our benefits somewhat." And I said to him, "Well, you seem to have the most ideal job in the world. 24 hours on, 48 hours off. And what could you do during that 48 hours? You could concentrate on your wealth. You could learn, you could study. Instead of learning how to becoming an engineer, you could learn how to invest better, more carefully. You could spend time looking for bargain properties. You could analyze. You could become wealthy. Having that job is just a way for you to support the habits you have, like eating and sleeping and paying your bills." But they were completely programmed to think in another way. You see, he wanted a job. He wanted security. He wanted someone else to be responsible. He thought that he couldn't become wealthy because he never thought about it. And I want to illustrate for you and make sure you understand that there are at least 9 major myths out there that are very, very entrenched, that govern the way people in the United States think about money. And it's sad. They think a job is good, but it's not. It's just a way of supporting yourself. And it will never take you to wealth. They think that security is good. But security is a myth. Never was. There is no such thing as security. There are only varying degrees of risk. And what he was doing, my fireman friend, was he was, in essence, relying on someone else to provide security for him when he could have been creating his own security. Think about those millions of people who are unemployed right now. Think about how much security means to them. Is there such a thing as job security? Do those 2 words go together anymore? Is there such a thing as social security? Do those 2 words go together? No. The only security you have is in between your own 2 ears. And even that is illusory. What about risk? You see, he didn't want to take the risk of spending 48 hours looking for his own fortune because he didn't know how to do it. He wanted to take the road that so many people have traveled down. And so risk was bad to him, and failure was bad to him. And this is what keeps so many people from making it. Remember that risk is the price you pay for opportunity. And if you want opportunity, instead of worrying about risk and failure, you've got to love it. Isn't that what our country is built upon? Risk. That's its greatness. Now what about someone else taking the responsibility? I'm sorry, but the government has taught us that they are becoming more and more responsible for us, when the only way that you can really become independent is for you to assume full responsibility for your wealth and not to let anyone assume it for you. And that last myth, at least one of the most entrenched, is that it takes money to make money. The reason he wasn't willing, my fireman friend, to go out and try and create his own wealth is because he thought you have to be wealthy in order to become wealthy. In other words, it takes money to make money, doesn't it? No! It doesn't have to be your money. It may take some money to get started, but what you need to get started is an idea. And then the rest comes, and the money is attracted to your good ideas, and it doesn't have to be your money. Now, I realize this sounds a little philosophical, and forgive me if you would, but it's important to lay a foundation. The last couple of myths let me mention so that you know what they are. People generally have an aversion to debt. They hate it. They say debt is bad. And there are 2 kinds of debt. There's debt for consumer items, yes. That's bad. You buy things that go down in value, that's stupid. At least if you don't have a lot of money. But the second part of that is there are investment debts. Debts for buying real estate, for instance, just to pull one off the top of my head. In order to become wealthy, let me make a bold statement, and I may shock a few, but you cannot become wealthy without going into debt. It is impossible. And therefore, if you have an aversion to debt, work on that. You've got to learn how to love debt. You've got to be able to say to yourself, I want to acquire debt, borrowed money, leverage, other people's money, OPM. I need it in order for me to become successful. Now, I want to get it carefully, selectively, well thought out, well organized, well planned, but I've got to have it if I want to become wealthy. And there are so many people who try and point us in the opposite direction. I remember a gal that was doing the engineering work on a radio program I was doing several years ago, and she listened to me talking about these concepts. And she came up to me after the program and she said, you know, Bob, what you're saying is so logical, but it goes against everything my parents have always taught me. And I looked at her and I said, how well are your parents doing? And she looked back at me with understanding and she said, oh, they're strapped to the wall. They haven't got 2 nickels to rub together. Now I understand. You can't let this programming overcome the principles that you need to create wealth. Now, what about that myth that I talked about right at the very beginning, the win-lose myth? Everybody thinks you have to be a crook to make it, but you don't. In fact, when you make it, generally you make it in a win-win way. Everybody wins, and you can have it that way. Where do we learn these myths? Where do we learn the myth about having to be crooked? I mean, it's blasted on TV every Friday night, every Tuesday night, every Sunday night, with Dallas and Dynasty and all the other programs. You don't have to be that way. That is only a minority of the way it really is. Now, we'll talk about the philosophical question of wealth. What is it? My favorite definition is wealth is when small efforts produce large results. Poverty is when large efforts produce small results. You can see it every day when you're driving to work, can't you? Do you drive to work? Are you listening to this tape right now in your car as you're crawling along the freeway on that trek to and from work every day? Large efforts. What results are you getting? Are you on the wrong road? You see, I like to put my wealth on automatic pilot, and I'll discuss that in detail with you in just a few moments. I like that wealth to come into me without me having to work for it. I like to have small efforts produce large results. That's what wealth is. But wealth is deeper than that, isn't it? Wealth is not money. It's not material things. It never was. I tried to prove this with a recent challenge I did with the Los Angeles Times, where they challenged me to live up to a statement I'd said on my previous book, which is a bestseller entitled Nothing Down. I said, send me to any city in the United States, take away my wallet, give me a $100 bill, and in 72 hours I'll buy an excellent piece of real estate using none of my own money. You see, they thought that my wealth was my credit, my financial statement, my cash, my equity, my job, my cash flow. And I said, if that's what wealth is, then take it from me, and then put me in a city and let me show you that that's not what wealth is. They dropped me off in the city, San Francisco to be exact. And on that morning at 8:30 in the morning, I stood there in the airport, and they took my wallet from me. The reporter at my side gave me 5 $20 bills. And in the next 72 hours, I was challenged to go out into that marketplace where prices were extremely high and to buy one piece of real estate using none of what they thought was the real wealth. It took me 57 hours to buy 7 properties, $722,000 worth of real estate, using none of my own money. You see, my wealth was in my head. It wasn't in my pocketbook. And once you grasp that concept, it's powerful, because then you learn that education is the shortest distance between wealth and poverty. And if you want to go from poverty to wealth, you need to put the information into your head. A machine in a factory broke down, and an expert was called in to fix it. He looked at the machine, and he said, I know what's wrong with it. He took his hammer out, he tapped twice in a certain place, and the machine immediately started to work. He handed his simple bill to the superintendent, and all it said on it was cost $250. The superintendent is aghast. I mean, how can you spend $250 for 2 seconds worth of work? And he was furious. He said, I want an itemized bill on my desk in the morning. And in the morning the bill came. Tapping with a hammer, $1. Knowing where to tap, $249. Together you and I are going to learn where to tap. And once you learn it, it's easy. Now, I know that sounds ridiculous, but once you understand where to tap, it's as easy as making that machine go. Therefore, wealth is not money, it is thoughts. It is not things. It is not cash. It is not material possessions. Wealth is what's in your head. How to create a wealthy mindset. You see, what so many people think is that it's your connections, it's the fact that you're born with a silver spoon in your mouth, that you're born under a lucky star. That's how you get so wealthy. But really and simply, the reason that the wealthy are wealthy is that they think wealthy. And the last thing you want to hear is that you have to change your attitudes, but that's the way it is. It has to be that way. How do you create a wealthy mindset? Well, there are 5 specific steps. First, you set goals. Now, I'll bet you've heard that before. As a matter of fact, in audiences I've spoken to around the country, I ask a question of the audience. How many of you have heard that it's important to set realistic financial goals if you want to become financially independent? And 100% of the people in the audience raise their hands. And then I ask the telling question, how many of you could now go to your homes and find for me a previously written set of written financial goals? And guess what? Maybe 3, 4, 5% of them raise their hands. They know what they ought to do, but they very rarely do it. And goals are so critical. The great Zig Ziglar tells a story I think's fantastic about the study they did at Yale University in 1954 when they took and asked a group of graduating students in 1954 how many of them had written financial goals, and guess how many? Only 3% had written goals. 10% had goals that were clearly fixed but were not written down, and 87% had no idea what they were going to do financially as they left school. They took that same graduating class and followed them for 20 years, and in 1974, they resurveyed and found out how well this group had done. And guess what? The 3% with written goals had done better financially than the other 97% combined. Now, I'm not saying that goals are essential, nor am I saying that if you don't have goals you can't make it. But what I am saying is they must help somewhat, and therefore I highly encourage you to write them down. And when you write them down, do the second step, which is visualize, will you? Visualize what it is you want those goals to accomplish for you. Suppose you pick a magic figure like $1 million. It's becoming less and less attractive these days because you almost need 5 million to make it anymore. But pick a big figure. What is it that you really want to do with your money when you get that money in your hands? Picture in your mind what it is you're going to do. Is it travel? Is it golf on all the famous golf courses in the world? Is it service to others? What is it? Imagine it. And the subconscious mind will help you reach it. I'll not take the time to discuss with you the ramifications and how the subconscious mind works, but do it. You'll see the results. Next thing, I'd like you to affirm your goals. In other words, work on programming yourself with positive thoughts. At the end of my book, Creating Wealth, I have 52 of, I think, the most powerful thoughts in my life, and I try and read them regularly. It keeps me on a positive tone. Let me read you a few of them. Andrew Jackson said, "One man with courage makes a majority." That kind of helps sometimes when you're worried about taking a risk. And then a friend of mine, Paul Jukes, said, "I'd rather see a crooked furrow than a field unplowed." That helps me when I need to get myself started. And then Joel Weldon says, "Don't compete, create. Find out what everyone else is doing and then don't do it." In other words, be creative. And then that great William James, who said, "Human beings can alter their lives by altering their attitudes of mind." Some of these thoughts, over and over again repeated, can help. You know, I even went so far as to create my own affirmation. I called it a 60-second commercial to me. Now, I know this may sound a little silly, and it probably was, but it surely helped me at a time when I was going through my graduate studies and my MBA program, and I was discouraged, and I needed help. And I sat down one day and I said, you know, I do have some blessings. I do have things to count on my side. And so I wrote down a 60-second commercial to me. "Bob Allen, you're great. You're one of the few individuals in the world who thinks the way you think." And I went on to say, "You're enthusiastic. You're a great leader, and although I wasn't, it sure helped myself to remind myself that I had that kind of potential. The next step is to replace all of those thoughts about luck with a new thought about probability. In other words, don't think about being lucky or unlucky. Think about having a low probability of success or a high probability of success, and you can always increase a low probability to a high probability. Case in point, my first book, Nothing Down, was a long shot. Let me tell you, every year 30,000 books come off the presses, brand new books, and the chance of them becoming a bestseller, like my first book was extremely small. My book, Nothing Down, remained on the bestseller list for 46 weeks. This is the New York Times bestseller list, and I must admit that's a long shot. How did I increase the probability that that would be a success, and I did not count on the luck being a major factor in it? Well, first of all, instead of sending my manuscript in to my editor, Simon & Schuster, since I didn't have a connection there, I knew that the probability of getting that selected was almost nil. So I went to a major publishers convention in Atlanta, and I waited until the right moment to talk to the president of Simon & Schuster. Now, I was frightened. My heart was in my throat. But I waited for the right moment, and then I showed him a complete package on my book that I had prepared before I got there, with a beautiful cover, a professionally edited few chapters, a table of contents with some catchy titles. He immediately saw that I had gone the extra mile and accepted the manuscript. You see, I didn't just leave it to luck. I tried to increase the probability that would be a success, but that wasn't all. I went out on a PR tour. I worked night and day to make sure that people around the country would learn about it. We created a seminar so that people could also come and spread the word. I only leave everything up to an increased probability of success, which I can control. And lastly, if you want to create a wealthy mindset, you've got to learn how to be a person of action. You must love to jump off those figurative cliffs and learn from your mistakes. How many business college professors do you know who know everything they need to know to be successful in their own business, but they can't put their knowledge into action? There are brilliant derelicts around us everywhere. But those who put their thoughts into action are the ones who succeed. My favorite Zen quote motivates me to action whenever I'm stuck on a plateau of comfort. It says, and this is profound, to me at least, to know and not to do is not yet to know. I encourage you to set your goals, to visualize them, to affirm them, to work actively towards realizing them through smart planning and fearless action. Once you have this foundation, you are ready to advance to the next step, the realm of principles. Have you ever heard the saying, a fool and his money are soon parted? Is this true? If I can confess a bit, one day I sat down and I analyzed all of my failures, all of those mistakes I've made along the road, and counted up to my dismay $212,000 worth of the most idiotic mistakes that you can imagine. Money out of my pocket that I would not have had to lose if I had understood the principles of wealth. As a matter of fact, perhaps I had to go through that loss so that I could understand those principles, and that I could share that information with you so that you don't have to go through that same kind of loss yourself. So what are these principles? Well, I have found at least 7 of them, and let me share with you how I discovered them. I wanted to do a survey, and therefore we prepared with an expert. A survey to find out what people would do with sudden wealth. We wrote down a question, and we said, here is $100,000 cash. Imaginary, of course. But suppose you received it tax-free. What would you spend it on? And we gave them about 25 categories in which they could spend it. House, car, boat, debt, church, charity, family, real estate, diamonds, gold, silver, etc., 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 bonds. And we said, if you'll respond to the survey, we'll be glad to send you a copy of a free book. And many people responded. And we discovered, scientifically, that they would take their money and they would invest it in certain kinds of things, things which would either go up in value or go down in value. And so we projected out over a 10-year period of time what would happen to the things that they had vested their money in, and we found out what the compound rate of growth would be of each individual item in our survey. And we were able to then determine what the market value of their shopping basket of investments would be worth in 10 years. Now let me ask a question, and you put it in your mind. How many of those people, let's say of 100, how many out of 100 would have been able to take that $100,000 windfall, tax-free, and only just double it in a 10-year period of time? What do you think? 20%? 10%? 5%? Did any of you guess 1%? Only 1 in 100 would take $100,000 cash and double it. Isn't that interesting? And yet, so many of us who don't have a head start like that, $100,000, are assuming, hoping that we can start with nothing and create wealth, when those with great wealth can't even double it. Well, let me make sure you understand that if you understand the principles of wealth, which I'm going to share with you, you don't have to have any money. But if you don't understand the principles of wealth, it doesn't matter how much money you have to start with, great or small. The probability that you will be successful is extremely small. What are these 7 principles? I'm going to cover them quickly. We have so much material. We were able to take the survey and pull out of the survey the 7 principles. Number 1, people forgot and always forget about taxes and inflation. Inflation may be lower now, but any inflation at all is devastating. It's just a tiny hole in your net worth that gets bigger and bigger as inflation grows, and you always have to plan for it. Number 2, make maximum use of your assets. You have to sacrifice to invest in things which go up in value. It was amazing to me that the average investor in our survey would take $30,000 to $40,000 of the money that they would receive and would immediately spend it on things which go down in value. And they would only then take the 60 or 70% that was left over and invest that in things which go up in value. So they weren't maximizing their assets. If they had had 100% of their money to work for them, it would have been easy for them to reach their goals, or at least easier. Number 3, don't diversify. In other words, instead of taking 60 or 70% of the money and putting it in 19 different areas of investment, which is what most people did, you should take your money and invest it only in a few areas. Now here we come across the programming of the world. What do most investment counselors tell you to do? They tell you to diversify. Don't put all your eggs in one basket. Who are they talking to? They're not talking to people who are creating wealth. They're talking to people who are perpetuating wealth. In other words, if you got a lot of money, yes, diversify. But what happens if you don't have a lot of money to start out with? You've got to learn how to concentrate it. And what did the wisest man, I think, in the United States say? As far as money is concerned, one of the richest at least, his name was Andrew Carnegie, and his motto was, put all your eggs in one basket and then watch that basket. In other words, if you want to create wealth, you've got to learn how to concentrate. And what most people in our survey did was they took and spread their money in 19 different areas. Many different areas. Number 4, wealth seekers are always on the offensive and not on the defensive. And yet what is the frame of mind of most investors in the country? They want security. They want liquidity. You know, I heard an advertisement on the radio the other day. A large savings and loan in California was saying on the airwaves, giving this kind of programming, listen to it. In a jingle song, they said, come in out of the risk. That was their motto. If I could have been there, I would have said to that songwriter, no, you don't say that. What you say is come out into the risk, for that is where the opportunity is. In other words, wealth seekers have to be on the offensive, willing to take risks. Number 5, money must multiply at wealth-producing rates of return. What does that mean? Well, suppose you have $5,000 cash today and you want to invest that so that it will grow to $1 million in 10 years. What compounded rate of annual growth will you need on your investment after taxes and inflation to have that money grow to $1 million? What rate of return are you going to need? The answer is 70%, 70%. But what investments do you know out there that can give you 70%? There aren't many, are there? Are they money market funds? I doubt it. Even the stock market is going to have trouble. You look at the best performances in the stock market by advisors in their newsletters, and 25% is tops. Not the bottom, but the top. How do you get 70% rate of return on your money? First of all, you have to realize that you do need high rates of return, and then you go to the sixth principle, which is you must choose investments that are both powerful and stable. Now, powerful, what do I mean by that? I mean leverage. I mean debt. We talked about that earlier. Debt. Other people's money. Let's take a piece of real estate, for instance. I buy a $100,000 house. I can get a mortgage. I can borrow $90,000 against that. I only have to put down 10% of my own money, $10,000. If that property does go up in value 10%, which would mean a $110,000 house, my investment of $10,000 now becomes an equity in a house of $20,000. That's 100% on my money, isn't it? You see what leverage did? Well, that goes against the grain, and most people don't like debt. That is one of the only ways that you will be able to get a high rate of growth, a wealth-producing rate of growth. But the problem with leverage is that it's a two-edged sword. You can have leverage in the stock market. They call it margin. You can have leverage in commodities. You can have leverage in lots of investments. But what you need are high rates of compounded growth over a long period of time. You need stability, don't you? And what doesn't the stock market have? Stability. What don't commodities have? Stability. There are investments that do have stability. Let's take money market funds or savings accounts in the bank. Bonds, for instance, they're a little less stable. These investments have stability, but what do they lack? They lack power, meaning I can't get a high rate of growth. So what investment is both powerful and stable? You come to only two or three, frankly. You're going to come to real estate, and you're going to come to certain rare numismatic coins. You're going to come to some form of discounted mortgages, but very, very few investments can you pick from. And I pick real estate. The reason I pick real estate is not because I like it. You may have heard me say on talk shows before, I hate real estate. There is nothing neat about it except the fact that it creates wealth. And it creates wealth because you can use leverage to obtain it, and it has long, slow, steady rates of minor appreciation over a long period of time. That's why it's exciting. And therefore that stability mixed with the power creates the wealth. We all understand this in a gut way. We know that real estate has lots of benefits, but that's the reason that you come down to it. It's stable and it's powerful. Number 7 in the principles is control. One of the reasons that real estate is good is that you control it. And one of the major reasons why I try to avoid myself the stock market is because you don't control it. You don't control the minor or major things that can happen to make your investments go up or down rapidly. How many people do you know that have taken money and given up control of it and given it to somebody else to manage that money for them and end up losing some of the money or all of it? That's happened to me. And the reason that I lost that $212,000 I referred to earlier is because I lost control of it. And then I couldn't rectify the problems that were created by another person. You've got to keep control. What did H.L. Hunt say about money? He told his daughter, never invest in anything that you don't control. I think that's pretty good advice. So a fool and his money are soon parted. Why? Because he doesn't understand investments. He doesn't understand leverage or compound interest or control, and as long as he doesn't understand these things and won't make the effort to learn them, his wealth is in jeopardy. But once he learns the principles, and he's not afraid to try them and to put them into practice, wealth comes easier. I like the quote from Will and Ariel Durant's book, The Lessons of History. The men who can manage men manage the men who can manage only things. And the men who can manage money manage all. And that brings us to strategies. And the strategy that we'll spend time on now is how do you now launch yourself into financial self-reliance? You've got a wealthy mindset. You understand the principles, basically. You've got your goals set. So what do? Where's some meat? Well, there are 4 stages of wealth, and each stage has its specific steps. Let me describe a wealth trajectory using real estate investments, although this would be the same if you were to start and manage your own business or anything else. I pick real estate because that's my experience, but any type of business that's well run can give you the same kind of results. The first stage, stage 1, is the pre-launch stage. This is the stage where you get your house in order. It's where you study. It's where you put the wealth in that you're going to need to use. In other words, it's getting your education. It's learning about investments. It's learning about leverage. It's learning to set your insurance up. It's learning to go to your banker and arrange for a good line of credit if you need it. It's doing those things that failures don't like to do. As one wise man put it, one small good deed is better than a grand intention. In other words, don't tell me you're going to be a millionaire. Start today to read, to study, to get your house in order so that you'll be ready when the time comes. This pre-launch stage is the time of many small, practical, mundane, seemingly insignificant actions which slowly compound our grand intentions into the realities of grand deeds. And this is where we lose most of America. They are not willing to make those kinds of sacrifices. What's stage 2? That's the liftoff. Imagine this space shuttle sitting on the launch pad in Florida. The morning is crisp. The booster rockets thrust that capsule up into the atmosphere. In order for it to overcome the enormous gravitational pull of the Earth, those booster rockets groan and strain and push that rocket upward through 50, 75, 100 miles worth of gravity. It's not until it reaches out beyond the Earth's gravitational pull that the rocket or the spaceship or the space shuttle just falls into an orbit. It just takes the breath of a baby to propel it then. But to get it off of that launch pad is extremely difficult. It takes effort. It takes work. And the same thing goes with reaching your financial independence. The first steps are hard. To overcome the inertia, the gravitational pull of the world, overcome the desire to spend your money and not to save is extremely difficult. You're tempted on all sides to spend the money that you have instead of invest it. But once you reach outside that, your rocket ship goes on in what I call automatic pilot. The second stage of that rocket is when it's groaning about 50 miles above the Earth. I call that the liftoff stage. This is the tough time. And the reason that it's tough is because you rarely see any results. It takes a couple of years for investing. For instance, if you're investing in real estate, it takes a couple of years for your equity to start to grow where you feel like the sacrifice that you put out is going to return your money back. Let me give you a sample investment program. Let's pick, for instance, an investment program of investing in 2 single-family homes each year for the next 10 years. Now, I know this may go against the philosophy of many who like to buy just one house and have it free and clear. I'm investing in 20 single-family homes in 10 years. That's the program I'm outlining. And so at the first 5 years of your program, you end up with 10 houses, but the equities are not there. They're not growing fast enough. The compounded rates of growth have not started to really take effect, and it's very discouraging. Your net worth at the end of 5 years is less than $200,000 on that program, assuming minimal rates of appreciation. And yet you've used up half of your time. You've used up 5 years and you're only 1/5 of the way there, but it's in that last step when the rates of compounded growth really start to rapidly increase so that you reach $1 million net worth by the end of a 10-year period of time, just investing in 2 single-family homes a year. That's exciting to me, to realize that if you can just persist and hang on by your fingernails, as I had to do, that things really start to happen for you. But we lose the rest of our country somewhere along that liftoff stage and they abort their mission. And they jump ship. They abort the mission. They go away saying, I tried and I couldn't make it. What I encourage you to do in this first liftoff stage is to concentrate, as I said as a principle, as much as 90% of your available discretionary investment capital into real estate. Learn how to manage it yourself and control it yourself. Always keep at least 10% of your liquid assets aside. Put them in what I call a staying power fund. For every property that you own, you should have at least 3 monthly payments worth of staying power fund aside in an emergency fund, so that if something goes wrong, you can always maintain your properties. And believe me, there will be things that go wrong that you'll have to plan for. Now, what about stage 3? This is the second 5 years of our 10-year program. And in this, what we call the pre-orbit stage, things really start to happen. The net worth goes up. You're beginning to be more and more efficient in your managing. You understand the business better. I would imagine that you'd concentrate 80% of your available investment discretionary cash into real estate. You should have a 10% staying power fund as you had previously, but now you should have an additional 10% of your liquid assets and put that into what I call a prime the pump fund. So what happens if the economy goes down the drain? What happens if we have a deflationary collapse? Am I going to lose everything I own? Well, no. You may lose some of your possessions, but you're not going to lose your knowledge. And at the bottom of any depression, you can always start again, especially if you've got some money put aside to pick up those bargains. You see, I'm not afraid of depressions, as most people are. If they come, they come. But that is the time when bargains will abound, and that is where many, many millionaires were made in the last depression. I don't plan for it, I don't hope for it, but I'm not afraid of it either. Stage 4 is when you go into automatic pilot. You see, at the end of your 10-year period of buying single-family homes, and I'll go into the details of this with you in a moment, you end up with 20 single-family homes, an equity of $900,000 plus in those 20 single-family homes. You've also got some money put aside in your staying power fund and your prime the pump fund. But what do you do now? I would imagine that you would feel wealthy. You've got $1 million. That's pretty wealthy, isn't it? Not really, because your equity is tied up in real estate, and that's not liquid, and it surely doesn't generate a lot of positive cash flow for you. So let me describe to you what I would do to get those 20 single-family homes on automatic pilot. I would pick the 10 homes with the largest equities in them, and I would sell them. I would want all cash, and it may take me a year, 2 years, sometimes 3 years to be able to find the right buyers with the right cash at the right price. When I sell a home, I take the cash and I pay off the mortgages on the other homes. The homes that we sell will generate enough cash to pay taxes to the IRS and to completely pay off the mortgages on the other 10. Now is when we go on automatic pilot. You see, because now we have 10 single-family homes completely free and clear. No mortgages. And imagine in 10 years from today when the rents on those homes would be, for ease of illustration, I'll say $1,000 a month. I've now got $10,000 a month coming in. Cash flow. Now, I have no mortgages to make, and so that money belongs to me. That's my automatic pilot. That's my goose that lays the golden eggs. Yes, I've sacrificed for 10 years to get there, but then I can relax a little bit. The money is coming into me without me having to work for it. Remember the statement I said earlier, wealth is when small efforts produce large results. Now the small efforts of just collecting your rents produces large results, the freedom you're looking for. And you know, it's not the money that wealth is so known for. It's the freedom. That's what you want, isn't it? The freedom to do what you want to do when you want to do it without having to be told. That's a very precious freedom, and it's worth getting, and it's not that hard to get. Now, automatic pilot is the term I use when the income is coming to me. I've got several automatic pilots in my businesses right now. I've got a seminar business that's totally on automatic pilot. I don't personally teach the seminars any longer. I train teachers to do that for me. I also have other businesses, a newsletter. I've got the book that I have printed and I'm selling nationwide. That's an automatic pilot. I did all the work to get it to the publisher, but now the publisher sells it and I just sit back and collect the royalties. Those are all automatic pilots. I encourage you to find automatic pilots because it's only when you have an automatic pilot that you have the real wealthy freedom that I'm talking about. Let me give you an example of someone who is not on automatic pilot but that most people think is wealthy. Let's take a doctor. Let's take a surgeon. The problem with a doctor or a surgeon is the fact that he can't train someone to take his place. He has to be there. And the only way he can increase his income is to do more operations. And there has to be a limit to that. Or to raise his prices, and there has to be a limit to that. He can't clone himself. And therefore, he has a limit on the amount of income he can make. Now, we might think that's a lot. But unless he takes his income and invests it in things that will generate for him automatic pilots, he will get to the end of his life with no more ability to earn income and no more income to sustain him or her. So look for things that you can put on automatic pilot. The reason I like real estate is for that very reason. It's an ideal creating wealth investment because once the mortgages are paid off, the income is generated to you and your family, your heirs, your posterity forever, as long as they maintain it correctly. That's what's exciting to me. Let's move into some more specifics. We've covered the entire picture from minimum wage to maximum wealth, but let's add some flesh to these bones. I talked earlier about buying 2 houses per year for 10 years. What about the details of just how you concentrate there and how you learn how to be in the right place at the right time? Let me give you the concept of target property. As I invest in real estate, I can choose many types of properties. I can choose recreational property, single-family homes, apartment buildings, commercial buildings, office space, etc., etc. Let me concentrate for you into one area that I feel has the greatest potential, and that is the area of residential property. I like to invest in things that people have to have. There is no choice. You don't see communities of tents around the country, at least not yet. And therefore, I like to buy single-family homes. And the target property I like to choose is a cheap single-family home, a 3-bedroom property. Condominium or townhome is okay. I like to choose it within a 50-mile radius of my own home. I like to choose it so that it can be purchased with a small down payment, if any, so that it does not have a negative cash flow. Break-even is my limit. And so that it can be managed easily. I like to put that in my portfolio and take care of it. That's what I call a target property. Anything that falls outside of target property, I'm not interested in. What's the limit in price for me? You want to have as cheap a 3-bedroom home as you can have in a neighborhood that you would feel comfortable about driving through at night with your windows down. Is that graphic enough? You want to have it in a suburb, a nice little houses all in a row neighborhood, if that also can help you illustrate. Your home should be priced hopefully under $75,000. There'll be some cities where that may not be the case, but the lower under $75,000, the better. In my area, we invest in homes between $50,000 and $60,000. That's the target price range that I'm looking for. Anything above that gets me into a lot of trouble. Gets me into the trouble of managing it, gets me into the trouble of paying negative cash flows. And that means the rent I collect from that house is not enough to pay for the mortgage payments and the costs of maintaining that house. And therefore, for me, it's not worth picking up. Now, why am I interested in those types of properties? You see, we're in a back-to-basics decade. People will be buying smaller cars, and they'll be buying smaller homes. And if they can't buy a home, they're going to rent one, and it's going to be mine. I'm going to control it. What they don't realize, most people, is that they can buy a house and negotiate excellent terms themselves, but they don't know how. So they end up without the knowledge to know how to get their own home. They come to me to rent it from me. Now, once we have chosen our target property, we next choose a cookie cutter. Now, what does a cookie cutter mean? A cookie cutter is a strategy that we use. You see, every successful real estate investor you ever find has a strategy that he uses, like a cookie cutter, over and over and over and over again, the same details, the same formula. You've got to pick a formula that works for you, and there are 8 or 9 or 10 of different formulas, a way of making, and there are 8, 9, 10 different ways of making money in real estate, because real estate is such a diverse animal. It's so varied. It's so exciting. And why is it so varied? Why is it different than the stock market? Because the stock market is a perfect marketplace. I know today what my stock can sell for by just placing a simple telephone call. But real estate's different. I can't place a telephone call to someone and know that I can sell it within a day. It's illiquid, isn't it? It's an imperfect marketplace. And the reason that it's imperfect is it's illiquid. We can't sell very quickly, and we really don't know what it's worth. It may take us 3 or 4 months to find out. Well, it's that very imperfection that creates the opportunity. Most people say that real estate is bad because it's illiquid. I say real estate is good because it's illiquid. It's illiquid, and therefore I can find opportunities in that. For example, I find a person who needs to sell. He needs to sell today. He needs the cash today. And he's willing to take a deep discount on the price of his property if we can solve that problem for him. And yet I know also that if I can solve the problem and pay him his money and get him out and assume ownership of that property, I can put that property back on the market again for sale. And if I find the right buyer quick enough, I can sell it at a profit. In one instance, I bought a 12-unit apartment building in the morning, put $50,000 down, and sold it in the afternoon and got my $50,000 back plus $9,000 cash the same day. Why can I do that? Because real estate's an imperfect marketplace. And the key to being successful is to become an expert in value, to become an expert in knowing how to appraise properties, what you think the market would pay for that property. Lots of people are not experts in that, and that's why they never do well in real estate. That's what you're going to learn how to do, and you're going to have to learn how to do that, or you will not be successful in real estate. Let's talk about these 8 cookie cutters that I'll describe here, different ways of making money in real estate, and you'll see that in almost every one of them, recognizing value is probably the key to it. The first cookie cutter is buy high, sell higher. Well, let's go back to the old stock market adage, which is the way you make money is you buy low, sell high, right? Well, the stock market is not really that way. You don't buy a stock low and sell it high. You buy it high and you sell it higher. You see, you're hoping that the stock goes up in value, but you don't really know. And the real estate analogy to that is buying a house today for what it's worth, holding on to it and hoping through appreciation that it will increase in value and selling it higher in a few years from now. The difference between the price you paid and the price you sell it for is your profit. Same as in the stock market. Well, appreciation rates have not been very high in the last few years. Does that mean that that game is now over with? Not necessarily, and I fully expect that appreciation rates will come back, but I don't have to bank on it, because I can always go to the next formula, which is the true buy low, sell high. Because in real estate you can really buy a property well below its current market value and sell it for a profit. That's what's exciting about an imperfect real estate market. For instance, I located a property recently where the seller was anxious to sell. He had a $60,000 property. He wanted to sell for $48,000 with nothing down. He was desperate to sell. Couldn't stand the property, couldn't stand the management. He was moving, and he was 3 months behind in his monthly payments. Those were all excellent clues, and he said, "Get me out. I want out immediately," and we were able to oblige his wishes, and he was ecstatic to get rid of it. Well, we pick up the property at $48,000. We know we've got a built-in $12,000 profit the second we buy it. Even if we turn around and sell it for $2,000 or $3,000 above what we paid for it, we can make an immediate profit. That's what we call buy low, sell high. What kind of formulas would you use there? Talk about the foreclosure models, people who are losing their properties to foreclosure. You talk about going to banks today. This is an excellent formula for many of you. Go to your bank. talk to the person who's in charge of real estate owned, REO, and say, I understand that you've foreclosed on many properties, and believe me, they've got some. And tell them you've done all the distasteful foreclosing. Tell us what you would like us to do to buy your properties. And many of the banks are very flexible. They want to get rid of those properties because that's not the way they make their money. The way they make their money is when you make your monthly payments. That's the money business they're in. They're not in the real estate business, and they're very, very anxious to have you take their problems off of their hands at wholesale prices or wholesale terms or both. I've done that myself recently, and I highly encourage you to do that. The third cookie cutter, buy low, don't sell. What do I mean by that? Can I buy a property low and then not sell it? Surely. Recently, I bought one of those properties from a bank. It was appraised at $45,000. They wanted to dump it at $39,000. They only wanted $2,000 down, which was below their legal or their usual limits. And they would agree to make me the loan to buy them out of that property at a very handsomely below the market rate. You see, I was solving their problem, and the philosophy or the attitude changes when you're helping a bank solve their problem instead of having the bank help you solve your problem. They sold me the property $6,000 below the market, and I moved in a tenant immediately. And now we have a break-even cash flow. I made an immediate equity gain that I can put on my financial statement, and I get marvelous tax benefits. In the first year alone, the $2,000 I invested in that one simple single-family home has been recouped many times over from the equity buildup and the tax shelter that was generated from that property. So it's an excellent formula. Now, when those mortgages are paid off on that home, since it's now a break-even situation and in 2 or 3 years it'll be a positive cash flow, when those mortgages are eventually paid off, that home will be an automatic pilot for my heirs for centuries to come, because they'll have the home and they'll also have the rent that comes from it. Could also be an excellent retirement program for myself. In 20 years from now, if I have 30 single-family homes, all coming free and clear at the same time, can you imagine the kind of positive cash flow that'll generate for my retirement years? Well, that's exactly what I'm doing, folks. The fourth cookie cutter, buy high, fix up higher. I personally don't have the skills to fix up real estate, but many people do. And they find these cosmetic fixer-uppers that need paint, carpet, touch-up, cosmetic work, some light landscaping, and they significantly increase its value by the way it looks, and then they turn around and sell it for a profit. And this is an excellent way to go. The cookie cutter number 5 is buy high, don't sell. Many of you have seen these ads recently in the newspapers offering properties for zero interest. For instance, you can buy a condominium in several cities still today for $75,000, put down 15 or 20%, and have a zero interest mortgage, which is paid off in 5 to 7 years. That means you will have to make higher monthly payments today, but at the end of 5 to 7 years, the property is completely free and clear. Then you've got a real automatic pilot on your hands. There are all kinds of ways to look at real estate and make money. The sixth cookie cutter is what I call don't buy. Do you mean don't buy real estate? Yes, don't buy real estate. Do you mean don't invest in real estate? No. I mean don't buy it, option it, control it. Control is important, not necessarily ownership. Can I lease a piece of property with an option to buy it? Yes. There are many ways and many advantages to leasing property and then turning around and subletting that property to another tenant at a higher rental rate, collecting the higher rental rate as a positive cash flow, and ending up with an option to buy the property down the road, assuming there may be some inflation, at a better price. It's an excellent formula, especially for those of you who are living in areas where the prices are extremely high and where it's very probable you'll have a negative cash flow by buying real estate. My cookie cutter for you then is to lease it with an option to buy it, or just to option it. The seventh cookie cutter, buy high, sell high. Is it possible for me to buy a piece of property for $100,000 and turn around and sell it a week later for $100,000 and still make money? Surely. You see, there are several kinds of wholesales in real estate. You've got wholesale price and wholesale terms. And if a seller is willing to accept wholesale terms, 9-10% interest on his mortgage, then all you have to do is turn around and sell it to someone else for a little bit higher terms, 11-12% mortgage. And you collect the positive cash flow, the spread between those two transactions, as a positive return to you for the next 25 years or until that mortgage is paid off. And the cookie cutter number 8, and this one is my favorite, is what I call buy high, sell low. Is it possible to buy a property for $100,000 and to sell it for $80,000 and still make money? Can I buy something high and sell it low and still make money? The answer is yes, of course. It's very complicated, but it's very powerful in the use of discounted mortgages that are out there, and trading mortgages and what we call substitution of collateral. And once again, it's a little technical for the discussion of a tape. It's kind of like teaching a person how to do an appendectomy over the radio, and therefore I'd rather that you had a chance to study it in a little more detail, but there are ways to do it, and it's very exciting and very, very little known, as a matter of fact. Now, as a summary to our discussion of cookie cutters, let me point you in the direction of the one I feel most comfortable about today, at least for the next 12 to 18 months. I would encourage you to pick the buy low, sell high formula. And as I discussed in that previous cookie cutter, go to your banks, your finance companies, your financial institutions in your area that have had the habit of lending money using real estate as security or collateral. And if you have to go through 19 no's to get one good yes, you have to learn to be that perseverant, because it's well worth the effort. I mentioned earlier the win-win philosophy, and win-win is a fundamental part of my attitude in dealing with sellers. I like to make sure that they win as well as myself. I like to walk away from the transaction knowing that I could have sat on the other side of the table in that seller's same shoes and have felt fair about what had taken place. Now, many things can cause a seller to want to sell, can cause a seller to want to accept a wholesale price or wholesale terms. But I want you to understand that you're a business person, and therefore you have to win too, and you want that seller to win. Talking about your side of the equation, how do you win? Well, as a business person, you need to have something at wholesale. As a matter of fact, if you don't get something at wholesale, you're not a business person, you're a speculator. And you will end up as so much wreckage on the shoreline of the investment world if you don't realize that investors don't make it in real estate. Only business people make it, and they need something at wholesale. So in the negotiation, you've got to remember the side of the equation. The win-win equation is you've got to win. And if you don't win, don't play. By the same token, you must let that seller feel that you are fair also. The philosophy has 5 or 6 principles that I like to follow myself, and I mentioned one to you earlier. If both parties can't win, don't play. You see, if it's not win-win now, it will eventually be lose-lose. What do I mean by that? I mean that if you take advantage of somebody, really nail them to the wall, eventually they'll realize how bad it was for them, and they'll pass a bad word of mouth around. And I guess ultimately, in the eternal sense, if you really took advantage of somebody, you will lose, either in this life or in the next one. There is no such thing as win-lose, and there's no such thing as lose-win. It's either win-win or lose-lose. So don't cause anybody to lose, and especially yourself, and then, of course, not the seller. The next principle is, since the essence of win-win is mutual problem solving, don't negotiate with people who don't have problems that they are motivated to solve. Don't negotiate with people who don't have problems that they're motivated to solve. Meaning, if they're not flexible, don't negotiate. Now, 90% of the sellers in the real estate market are not flexible. So your very creative solutions to solving your cash problems or your business person problems will not be well received, because they're in the same business. They're business people. They're trying to make a dollar too. You've got to find people who are motivated by the problems that they have to be very flexible in the way they sell their properties. And that's a key fundamental principle of success. If you don't use it, you'll be very, very sorry. If you do use it, you'll see how powerful it is. If 90% of the people are not flexible, most Americans would say then that's not very good odds. But I look at it differently. If 10% of the people are flexible, that means I'm definitely going to be able to find somebody out there from whom I can buy a property. So, it's a numbers game. I know I'm going to get 9 no's before I get a yes. In fact, I'm going to get 9 no's before I get a maybe. And I'm probably going to get 5 or 6 maybes before I get a good solid yes. And I may have to go through 2 or 3 good solid yeses before I get an absolute yes, let's close. It's a numbers game, and you never can lose if you continue to persist. Now, the third principle of win-win is make friends with the seller. He will be more apt to enter into problem solving with a friend than with an enemy. You see, your attitude to negotiation is not negotiation, it's problem solving. Mr. Seller, I understand you have a problem. Would you tell it to me? Let's try and solve it together. I'm here to help, not to hurt. Let's work out something that's beneficial for both of us. Let's be fair. Instead of, I'm your adversary, I want to knock from you the last quarter in your piggy bank. It's a different attitude, and it's really very powerful. It's really do unto others as you would have them do unto you. And some people feel that that might have gone out of the window 2,000 years ago, but I can vouch for you that it works today very powerfully. Number 4, you can't solve a problem unless you understand it. So as you get involved in the negotiation process, listen. Get to the real problem. Mr. Seller, why are you trying to sell? And he tells you that they just decided that they don't want their house any longer, they want to move on. They want to know if you're a safe place, if they can divulge their problems to you. And so you have to listen. And after listening, you'll discover that generally the problems that they tell you at first are not the real root of the problem. They may be 3 or 4 months behind in their payments, and they're embarrassed to tell anyone about it. Once you learn that kind of information, you can help them solve their problem in a way that is beneficial to both parties. 5th principle, once you understand the problem, search for an alternative win-win solution. Ways in which you can come out with something wholesale, price or terms, and then they can leave and have their problem solved. And remember that optimism in investing is the root of persistence. You have to be optimistic or you can't persist. And remember, it's a numbers game. You cannot fail. If you go through enough sellers, you will find a bargain. And when you find that bargain, you can put it in your portfolio and you are on your way to wealth. The problem with most investors is that they have plenty of non-financial resources like lots of time and lots of courage. But no financial resources like no cash and no cash flow and no credit. The essence of wealth is to understand that all wealth is found in non-financial resources. And that is only the appearances of wealth that are found in the financial resources. Therefore, if I am broke, what do I do? First of all, you don't let it bother you, because the motto of a leveraged investor is, if I don't have it, somebody does. A new challenge I'll be performing here shortly goes something like this. Send me to any unemployment line. Let me select one individual who is out of work and discouraged. Let me teach that person in 48 hours the principles of creating wealth. And in 90 days, this person will be off the unemployment line with $5,000 cash in his or her pocket, well on his or her way to a life of financial independence and self-reliance. How can you perform that kind of quote-unquote miracle if you don't have financial resources? By the simple understanding that any financial resource you don't have, you can always borrow, no matter where you're coming from. That is the power that gets you started. When you do go into debt, you create family tension, and the last thing you want to do is to wreck a family over money, to ruin your real wealth over something that's transitory at best. Second problem, it's easy to borrow money, but not as easy to pay it back. And that's obvious, but most people don't understand that. And number 3, leverage increases the danger of losing control. So leverage is a tool that we use very carefully, like a surgeon would use a scalpel. With practice, very wisely, it is something you need to have. Let me recommend 2 or 3 investments for you. I would recommend, first of all, investing in discounted second mortgages, third mortgages, first mortgages, discounted mortgages or trust deeds. What is that? Suppose you own a home and you want to sell it. It's worth $100,000 and you have a $50,000 mortgage against it, so your equity is $50,000. That's the amount of money you would hope to receive. And someone comes in and makes you an offer. They say, here's $30,000 cash down, and we want you to carry the balance of your equity in the form of a second mortgage secured against your property, and we agree to make you monthly payments of XYZ dollars at 14% interest for the next 10 years. And you analyze the situation, you realize the market's a little slow, and you say, well, I get $30,000 cash and I get so many dollars a month for the next 10 years, I'll take it. You are now the proud holder of a mortgage or a trust deed. You receive monthly payments for the next 10 years. Something happens in your family about a year later. You receive these payments faithfully, but you realize that you've got an asset there that has a value of, on its face value of $20,000, but you realize that receiving this monthly payment for the next 10 years is really not what you want. What you really would rather have is some cash. And so you go to the marketplace and try and find out what you could sell that $20,000 mortgage for at its face value, and the market tells you that they may only pay $12,000 cash for it today. And you say to yourself, which would I rather have? A monthly payment for the next 10 years or $12,000 cash today? You might accept that. In fact, many people would. They might have an opportunity they could invest that $12,000 in to give them a much, much better return on their money. This is what we call discounted mortgages. A person who would pay $12,000 for a mortgage like that would probably earn a yield on his investment of between 18 and 24% on his money, which is significantly higher than you can obtain in a money market fund or in a bank, and probably in most traditional investments. What are the problems with investing in mortgages? Well, obviously, you have to be willing to take the risk that if a person doesn't make his payments, you'll have to foreclose. And therefore, every time you buy a mortgage, you have to say to yourself, am I prepared to foreclose on this mortgage and to obtain the house or property back? Do I really want to own the property that this mortgage is being collateralized by? If you decide you want to invest in that particular mortgage, then you sit back and receive your monthly payments for the next period of time. The next area of investment that I would encourage you to look into is the area of numismatics. What is that? That's rare coins, gold and silver coins that are pre-1965. It's a very specialized field, but it has very wonderful benefits. And one of the benefits is its rarity. Real estate is great because it's rare. It's hard to make, it's hard to sell, it's hard to create. And coins are even rarer because they're not making them any longer. The reason that a coin is rare is because there are no others like it. I encourage you to become experts in this area. As a matter of fact, I'm beginning to do this myself, and this is an excellent time to start. I would encourage you also to invest some of your money in real estate limited partnerships. Generally speaking, as you're creating wealth, limited partnerships are not the way to go. You want to control. But once you reach a plateau of wealth, you want to spread your efforts out and get only perhaps a piece of the action and not the whole thing. Limited partnerships are excellent. I would analyze a limited partnership the same way I would analyze a property that I would want to buy for myself. A final note on education. How did I get my start? I'll tell you when the spark came on for me. When I was attending a little-known seminar in California on real estate investing, and it was taught by an investor who was very creative. And he was the first one who got through to me and made me realize that I was in control and that creativity was more important than money. From that point on, I've never looked back. That investment of $1,000 for the seminar and for the travel and the hotel expenses has been worth a multi-million-dollar net worth to me today. And it came because I had the courage to spend money on a little-known, very unrespectable seminar. Since that time, I've gone to dozens of seminars, literally. And every one I've learned something because I meet and rub shoulders with the doers who are out there. I must admit, frankly, that I didn't learn any of this in my MBA program. What they taught me to do in my MBA program was to get a job and to work for someone else for the rest of my life. Thank heaven I could get a job so that I could spend my life creating my own job. And that was very important to me at that time. We also teach a 2-day seminar discussing the principles and the techniques of creating wealth. And I highly encourage you to take that. Not that I'm going to obtain an awful lot of money from it, but that I'm going to encourage you to become hooked on education as I have become hooked on education. Those who don't understand wealth are fond of saying, you can't take it with you. But I disagree. Just the opposite is true. You can take it with you. It is only the poverty-minded who tend to think that wealth resides solely in material things. Those who look upon wealth as thoughts and attitudes will not be disappointed in death, for they will be able to carry their wealth with them. My hope is that in creating the kind of wealth you can't take with you, you also create a generous portion of the kind of wealth that you can take with you. Good luck and Godspeed.